Thanks for tuning in to this week's Signature FD investment webcast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, we're going to start out here with our chart of the week, in which we warn investors to expect a wide range of outcomes over the next decade. So, this chart here shows forward 10-year returns, net of inflation, when the market has started in its cheapest quintile all the way to when it started in its most expensive quintile. Now, the cheapest starting points are shown in the far left bar, while the most expensive starting points are shown in the far right bar. The orange dots are median 10-year annual returns, and the blue bars represent the range of outcomes. Note how when one starts investing in the cheapest quintile all the way to the left, the median return for the next 10 years has been about 14% per annum and fallen into a range of 12 to 15%. That's a very tight range of outcomes. However, when the market has been in its most expensive starting point all the way to the right, the median return for the next 10 years has still been a respectable 6% net of inflation, but there was actually a 10-year period that was up 15% annually and one that was down 7% annually. That's why we want to be cognizant that the range of outcomes for the next 10 years is really quite wide. So what can we do about that? Well, two things. We can diversify our holdings into other assets with positive expected returns, and we can also take a true grow, protect, give, and live approach, where we allocate growth capital for the long term to the stock market. This chart here is interesting because it shows a range of outcomes, but over rolling periods of time, regardless of starting valuation. The blue bars are stocks and the gray bars are bonds. So on the far left, we can see that in any given calendar year, stocks return an average of 13%, but have returned as much as 53% and lost as much as 37%. Given that extreme negative outcome over 1 year, we want to think about elongating our time horizon for our grow capital. So take a look at the far right where we show 25-year returns. Stocks have been up 8 to 17% annually over all 25-year periods. So we want to use stocks to grow long term. And we can start looking at bonds for live capital. The 5-year rolling return on quality core bonds has been between 0 and 18%. So chances are, over a 5-year period, bonds may provide positive returns. But even bonds have lost as much as 13% in a 1-year period. So our protect capital probably should be lower duration and closer to cash. Now, turning to some economic trends, we would note that the soft data, which is primarily comprised of surveys, has continued to deteriorate. Last week, small business and home builder confidence each fell. And here we're showing consumer sentiment, which is now about as low as it was in the pandemic. So the surveys are really quite dire here. Now, the hard data, however, has continued to hold up. Here we're showing retail sales in blue, and we can see that year over year, retail sales are up a very respectable 4.8%. We would also note that job losses continue to be minimal. Our friends at Ned Davis Research like to say, no job loss, no recession. The longer the survey data remains depressed, the greater chance that consumers will actually change their habits and the hard data will weaken. But for now, there just remains a big divide with actual activity holding up pretty well. Now, we also got the latest read on consumer inflation last week, and it came in at a relatively benign 2.3%. That's the lowest level since the big inflation spike. If one stripped out shelter, inflation would be running 1.4%. That's below the Fed's 2% target. Now, that could give the Fed some scope to cut interest rates here at their June meeting. The market rally has likely been driven by the anticipation that monetary policy may ease in the summer and a tax bill could provide some fiscal support. So, here in this chart, we're showing market performance relative to Fed policy and the fiscal budget. When Fed policy has been easy and the fiscal budget deficit is expanding, stocks have tended to perform quite well, gaining over 10% per year without even factoring in the 2% or so in dividends. Now, a notable development in the rally thus far, market breadth has improved pretty dramatically. In orange, in this chart, we're showing the percent of all US stocks that are trading above their respective 50-day average price. As of Friday, this indicator got to about 81%. That's a healthy number, but it is short of the 90% threshold we like to see to signal that the all clear for the 12 months of market returns ahead. Now, we can't end this webcast without touching on the Moody's debt downgrade. Moody's is the last of the three ratings agencies to downgrade US debt. The budget deficit itself isn't a huge issue so long as the growth rate of the economy exceeds the interest rate owed on that debt. But recently, economic growth, shown in the middle clip in black, has converged with long term treasury rates shown in red. Growth below the financing cost is an unsustainable condition, hence the downgrade. In the past, economic growth below borrowing costs has led to deflationary pressures on the economy. Wrapping things up, here's the returns of select asset classes through last Friday. We can see that the S&P 500 has now turned positive year to date, but there's been very clear leadership from developed and emerging international stocks. Global diversification has paid off thus far here in 2025. So to wrap things up, higher starting valuations have tended to be met with a wider range of outcomes in the next 10 years. Investors can narrow their range of outcomes through diversification and a grow, protect, give, and live approach to investing. There continues to be a wide gap between the soft survey data and the hard economic data. Inflation came in relatively benign for April, and the Fed may soon be able to resume a rate cutting cycle. Market breadth has been encouraging, which could be a positive signal for market returns in the 12 months ahead. Now, the debt downgrade does make sense in the context of economic growth and interest rates, and international markets have continued to lead in 2025. So that's all we have for the update this week. As always, thanks for listening and have a great week ahead.